Have you ever turned on the financial news, maybe you're having your morning coffee, and you hear someone just confidently claim that gold is skyrocketing because of inflation? Or fear? Or, the all-powerful money printer?
Right, the classic narrative.
Exactly. It's a story we have all heard 1,000 times. You see the ticker scrolling at the bottom of the screen, you see the pundits in their suits, and the narrative always sounds so incredibly logical.
Oh, it makes perfect intuitive sense.
Right. Inflation goes up, your purchasing power goes down, so obviously you buy gold. Panic hits the stock market, everyone gets scared, so you buy gold. It's practically treated as a law of physics in the financial world.
Almost like gravity.
Yeah, but what if almost everything the financial media tells you about what moves gold is actually completely wrong?
Yeah.
What if the narratives are just stories and the mathematical reality tells a completely different tale?
And that is exactly the premise of our deep dive today. We are looking at a truly massive, institutional-grade, quantitative study that was recently published by Brokers DB.
And we should clarify, when we talk about scale here, we are not looking at a handful of charts drawn over the last couple of years.
No, not at all. We are talking about an analysis of 22 years of continuous macroeconomic data. This stretches from 2003 all the way into early 2025.
Which is just a staggering time frame.
It really is. They analyzed 67 different macroeconomic indicators. They processed over 7,000 individual trading days. 7,016 to be exact.
Wow.
Which gives us 260 monthly observations. The mission here is to completely separate the popular narrative from the hard statistical truth.
Let the data speak for itself.
Exactly. We're going to let the data speak.
Yeah.
And to do that, the researchers used some incredibly rigorous statistical methods. They didn't just look for basic visual trends on a chart.
Right. No drawing lines with a crayon.
No. They applied Pearson and Spearman correlations to measure linear and nonlinear relationships. They utilized Markov chains to analyze sequence probabilities, and they conducted deep, fat-tail distribution analysis to really understand extreme market crashes.
Okay, let's unpack this. Because the sheer scale of that data is exactly what makes this so compelling for you as a listener. Over 7,000 trading days means they are not cherry-picking a specific crisis.
Or a specific bull run.
Right. They are looking at the entire modern era of monetary policy. We're talking pre-financial crisis, the zero interest rate environment of the 2010s, the pandemic, and the recent inflation spikes.
The whole spectrum.
Yeah. If you are managing your own portfolio, this is the kind of empirical foundation you actually need, rather than relying on whatever the flashy headline of the day is.
Yeah.
So let's dive right into their first major revelation, which they refer to as the Macro Correlation Bible.
The Bible.
Yeah.
It's a bold title, but
Yeah.
the data backs it up.
They tested gold against 67 different economic indicators. Now, logically, based on conventional wisdom, I would expect things like the consumer price index or unemployment numbers to be heavily correlated with gold's movements.
You would certainly assume that based on the media coverage. But the results fundamentally rewrite that assumption. Out of those 67 macroeconomic indicators tested, only 13 had statistically significant correlations with gold's monthly returns.
Wait, only 13 out of 67?
Only 13. And that's at the standard 5% confidence level. If you tighten that to the stricter 1% threshold, only 9 indicators clear the bar.
That is wild.
What this mathematically proves is that the vast majority, and we're talking over 80% of the macro data that financial media obsesses over every single day, has absolutely no statistically meaningful relationship with what gold does on a month-to-month basis.
So all that daily noise, the minute-by-minute dissecting of manufacturing data or housing starts?
Completely irrelevant to gold's pricing mechanism in that time frame, yes.
That is a staggering amount of noise to filter out. I mean, if 80% of the standard economic dashboard is practically useless for tracking gold, we need to look very closely at the surviving 20%. What actually made the top of the list? What is driving the math?
The top 8 drivers are all interest rate variables, and they all have negative or inverse correlations.
Okay.
But the undisputed king, the #1 driver across the entire 22-year data set, is the U.S. dollar index, commonly known as the DXY.
The dollar.
Right. It has an inverse correlation of negative 0.4481. When the dollar index strengthens against a basket of foreign currencies, gold reliably weakens, and vice versa.
Which makes intuitive sense. It's priced in dollars.
Exactly. Following right behind the dollar are the 5-year, 2-year, and 10-year Treasury yields. In fact, the only positive correlation to make their top 10 list is the 5-year break-even inflation rate.
Now, that's a crucial distinction we need to make for the listener, right? Because that particular indicator measures the bond market's expectation of future inflation,
Yes.
not the inflation that has already been reported by the government.
That is the absolute key. Gold is a forward-looking mechanism. It responds to what institutional capital thinks inflation will be over the next half-decade. It doesn't care what the Bureau of Labor Statistics says it was last month.
That makes a lot of sense from a market psychology standpoint. Markets price in the future, not the past. But this brings us to what the study calls the non-factors. And honestly, this might be the most counterintuitive part of the entire research paper.
Prepare yourself.
When we look at the list of indicators that do not move gold, it includes the Consumer Price Index, headline inflation.
Yep.
It includes core CPI. It includes the VIX, which everyone knows is the stock market's primary fear gauge.
The fear index.
It even includes non-farm payrolls, the big monthly jobs report. All of these have essentially zero statistically meaningful correlation with gold's monthly returns.
None.
The ultimate inflation hedge doesn't react to inflation data.
What's fascinating here is the distinction the researchers make between what they call returns correlation and level correlation. This concept is the absolute key to understanding the inflation paradox that trips up so many investors.
Break that down for us. Returns versus level.
So returns correlation measures how things move together dynamically on a month-to-month basis. If CPI goes up 1% this month, does gold go up 1% this month?
And the data says no.
The data definitively says no. That is where you get the 0.028 correlation. You are batting zero.
Right.
But level correlation measures long-term structural tracking. Relation between the gold price and the CPI index is a massive 0.898.
Wow. Okay, I want to make sure we ground this in a practical way for you, the listener. Let's say you're looking at your portfolio and you see a hot inflation report drop on a Tuesday morning. Buying gold that exact day, hoping for a quick tactical trade to offset that specific inflation print, is statistically useless.
You are essentially guessing.
Right. If we elevate the classic weather analogy here, trying to trade gold month to month based on CPI prints is like trying to understand rising sea levels by measuring the height of a single wave during a storm.
I love that analogy.
The daily wave tells you nothing about the structural tide. Gold is a structural...
Applies to the federal debt to GDP ratio. Over decades, gold has a 0.902 level correlation with fiscal deterioration.
So it tracks the debt.
It tracks the expansion of the national debt almost perfectly over a 20-year horizon. But if you look at it on a monthly basis, the correlation is negative 0.0110.
So month to month, it's just random noise.
Completely random. This fundamentally shifts how an investor needs to view gold's role in asset allocation. It is a foundational long-term structural asset. It is not a surgical instrument for day trading government data releases.
Which naturally brings us to the most pervasive structural narrative of the last decade. The money printer.
Ah, yes.
The printer.
This is the thesis that central banks expand the money supply, the fiat currency is debased, and gold naturally reprices higher to preserve purchasing power. It is the core argument for almost every single gold advocate out there. Does the empirical data from BrokersDB actually validate this thesis?
It does validate it, but with the significant nuance that challenges how people time their investments. Let's start with the raw, overarching scorecard. From 2003 to early...
Okay, so a massive expansion.
Massive. Over that exact same 22-year period, gold's nominal price grew by 711.9%.
Yeah, hold on, let me stop you there because we need to examine that delta. Yeah, it's huge.
If M2 went up about 250%, but gold went up over 700%, that means gold isn't just a one-to-one mirror of fiat debasement. It outpaced the money printer by nearly 2.75 times.
Correct. So if you mathematically adjust gold for the massive expansion of the fiat money supply, gold didn't just tread water. It delivered a real money supply adjusted appreciation of 126.5%.
That implies there is a massive speculative premium, or perhaps a risk premium, being priced into the metal beyond just the raw increase in currency units. It's actively growing real wealth even after accounting for the flood of new money. But you mentioned a nuance in how this plays out.
Yes, the study identifies what they call the regime paradox. The researchers didn't just look at the 22-year
liquidity. And QT is when they are shrinking the balance sheet and pulling liquidity out of the system.
Exactly. Now, the pervasive market narrative dictates that gold should explode higher during QE because the printer is on, and it should crash during QT because liquidity is drying up.
That's what everyone assumes.
But the data reveals the exact opposite. Gold actually performed nearly twice as well during quantitative tightening.
Wait, what?
It averaged a 13.78% annualized return during QT periods. It sounds totally backwards.
It does. The Fed is literally destroying currency units during QT. They are pulling money out of the financial system. Less liquidity usually means risk assets and non-yielding assets suffer. How is it mechanically possible that gold generates a nearly 14% annualized return when the central bank is actively tightening financial conditions?
To understand that, we have to look past the isolated variable of the balance sheet. We have to look at the broader market environment that forces the Fed into these regimes in the first place. Think about the specific periods of QT in this 22-year window. We are primarily looking at 2017 to 2019, and then the highly aggressive cycle of 2022 to 2024.
You're right.
What else was happening mechanically in the markets during those times? First, these were periods characterized importantly from a trading perspective. Markets are forward-looking. During a QT cycle, the market is constantly trying to price in the breaking point. The moment something in the economy snaps and forces the Fed to reverse course back to easing, gold starts pricing in the future pivot, long before the tightening actually stops.
So it's the anticipation of the pain.
Yes, easing. Like the post-2008 era, you have zero interest rates and massive liquidity pushing investors further and further out on the risk curve.
Equity markets typically roar during QE.
They absolutely roar. If you are an institutional portfolio manager and the S&P 500 is returning 15 or 20% a year fueled by cheap leverage, you have a fiduciary duty to chase that yield. Capital flows aggressively into equities and out of defensive assets.
So gold gets left behind.
Gold has a high opportunity cost during those massive liquidity-driven equity bull markets. So the simplistic meme of money printing equals gold going up immediately ignores the reality of how institutional capital actually rotates between asset classes.
So applying this to your own strategy as a listener, if you understand that gold outpaces total fiat expansion by a factor of nearly 3 over the long haul, you treat it as a foundational portfolio anchor. You hold it because the structural math of long-term money supply expansion is fundamentally in your favor.
Right. You don't trade the daily headlines.
Exactly. You do not panic buy or panic sell just because the Federal Reserve announces a $50 billion tweak to their balance sheet roll-off this month. The month-to-month price action is driven by complex capital flows and forward expectations, not the contemporaneous size of the Fed's balance sheet.
Precisely. The statistical correlation between gold's monthly returns and the exact size of the Fed's balance sheet in that same month is exceptionally weak. It is the decade-long compounding of debasement that actually manifests in the price.
This transitions us perfectly into a discussion about how traders measure risk and panic, which brings up my favorite myth-busting section of this entire study, the safe haven myth.
This one is going to upset a lot of day traders.
It really is. When the stock market crashes, when the VIX spikes, the immediate reflex for almost everyone is to assume gold is the ultimate safety net. It is so deeply ingrained in market psychology.
And this is where the quantitative data is truly merciless to conventional wisdom. The mathematical correlation between the VIX, the standard measure of equity market volatility, and gold is negative 0.023.
As we established earlier, that is statistically zero.
It is zero. But the Brokers DB researchers didn't stop at simple correlation. They isolated the 15 absolute worst VIX spikes of the last 22 years. We are talking about the truly terrifying moments in modern financial history.
The depths of the 2008 global financial crisis.
Yes, the 2010 flash crash, the European sovereign debt crisis, and of course the 2020 COVID-19 panic. During those 15 extreme paradigm-shifting events, gold's win rate in the concurrent month was only 46.7%.
I need to pause here because a 46% win rate during a VIX spike is technically worse than a coin flip.
Literally worse than tossing a coin.
But doesn't that directly contradict our shared memory of what actually happened? Let's take 2008 as an example. Everyone remembers gold eventually acting as a massive safe haven and launching into a multi-year bull market right after the financial system nearly collapsed. Is the data somehow missing the reality of that crisis?
The data isn't missing reality. It's highlighting a critical sequencing error in how retail investors perceive crashes. The true safe haven trigger for gold is not equity volatility, it is credit stress.
Credit stress. Okay, define that.
To measure this, the researchers used high-yield corporate bond spreads. That's the difference between the yield on risky corporate debt and safe government bonds. When these spreads widen above 6%, it signals severe distress in the underlying credit markets.
Meaning corporations are struggling to borrow.
Liquidity is freezing up, and systemic bankruptcy risk is rising. In those specific credit stress environments, gold doubles its average monthly return, and its win rate jumps from 46% to over 60%.
So if the VIX measures the panic of stock traders, the high-yield spread measures the panic of the actual banking and credit system. Why does gold care so deeply about the credit markets freezing, but essentially ignore the stock market throwing a tantrum?
It comes down to a structural market mechanism called the liquidity trap phenomena. Let's look exactly at the timeline of October 2008 or March 2020. When a true systemic panic hits, asset prices plummet across the board.
Everything goes down.
Everything. Institutional funds, hedge funds, and heavily leveraged traders face massive, immediate margin calls from their prime brokers. When you get a margin call in a freezing market, you do not get to carefully select which assets you want to sell based on their long-term fundamentals.
You just sell what you can.
You sell what you can sell. You sell whatever is still liquid and has a bid because you need US dollars immediately to survive the clearinghouse. Gold is an incredibly deep, highly liquid market.
Yeah, so it gets caught in the crossfire.
Exactly. In the initial phase of a systemic shock, gold gets dumped indiscriminately alongside the toxic assets simply to raise cash. It's a brutal, sell first, figure it out later dynamic. It is only after that initial scramble for liquidity subsides and central banks step in to backstop the credit markets that gold recovers and begins its massive multi-year safe haven rally.
That sequence changes everything about how you deploy capital during a crisis. If we elevate the classic life raft analogy, imagine you are on a massive ship that is suddenly sinking. Gold is the life raft. When the ship first starts going down, the sheer vacuum and suction of the massive sinking vessel pulls everything down with it, including the life raft.
Pulls it right under.
Right. If you are watching from a distance, you might say, look, the life raft is sinking too. It's a terrible asset. But it isn't structurally failing. It's just temporarily caught in the liquidity vacuum. The moment the pressure equalizes and the dust settles, the life raft shoots to the surface and performs exactly as designed while the ship stays at the bottom.
That is the perfect way to visualize it.
So the critical takeaway for you as an investor is that gold is a post-crash recovery asset. It is not a real-time day-of-the-crash hedge. If you buy it the day the market breaks, you are likely going to get pulled into that initial liquidity vacuum.
That is exactly how a portfolio manager has to model the risk. And since we are heavily discussing the mechanics of delayed reactions, this transitions thematically into one of the most profound and actionable discoveries in the entire study, the inflation lag.
Yes. This part is fascinating. We established in the first section that contemporaneous CPI has zero correlation with gold. Buying on inflation report day is useless.
Clearly.
But the researchers hypothesized that the relationship must exist somewhere across time, right? So they ran a massive cross-correlation analysis testing gold's price against CPI data at every possible time lag from 0 to 60 months.
They tested every single month to find the sweet spot.
If contemporaneous CPI means nothing, but level correlation over decades means everything, there has to be a mathematical bridge between the two. How long does it actually take for a single massive inflation shock to fully price into the physical metal?
The cross-correlation analysis revealed that the peak mathematical correlation happens at exactly a 35-month lag.
35 months.
At that specific point, the correlation coefficient jumps from near zero up to 0.360. What this indicates is that gold's price action today is most closely and statistically correlated with where headline inflation was nearly 3 full years ago.
A 3-year delay is an eternity in financial markets. Most traders can't hold a position for 3 weeks, let alone 3 years. We really need to break down the mechanics of this. Why on earth would it take 35 months for a deeply liquid global asset like gold to figure out that inflation happened?
It's not a matter of the gold market being slow or inefficient. It is a reflection of the mechanical sequence of macroeconomic policy. Let's walk through the chain of events.
Okay, step 1.
Step 1. A major inflation shock hits the economy. Step 2. The Federal Reserve, realizing they're behind the curve, panics. They aggressively hike interest rates to destroy demand and cool the inflation.
Right.
Step 3. Because nominal interest rates are suddenly soaring, the opportunity cost of holding gold, which pays zero yield or dividend, becomes very high relative to risk-free cash sitting in a money market fund. So paradoxically, gold actually drops or stagnates during the peak of the inflation panic.
Because capital is flowing to the newly attractive 5% Treasury bills.
Exactly. But let's fast forward a couple of years. We reach step 4. Those high interest rates have done their job, but they have also caused severe structural damage to the economy. Unemployment starts rising, corporate defaults increase, and growth stalls.
The hangover kicks in.
Yes. Step 5. To prevent a deep recession, the Fed is forced to start cutting interest rates. Step 6. The sudden drop in yields removes gold's opportunity cost. Furthermore, the structural damage of the initial inflation, the permanently higher baseline prices of goods, and the larger fiscal deficits required to stimulate the weakening economy is now deeply embedded in the system.
And that is when gold surges.
Yeah, is when gold surges. The 35-month delay, IS, the transmission mechanism of central bank policy.
And we don't even have to look at dusty history books for this. Think about what you as an investor were doing in 2022. We just lived through the most perfect real-world case study for this exact sequence, the 2021 to 2024 macro cycle.
It was a textbook execution of the model. In mid-2022, U.S. CPI spiked to a 40-year high of 9.1%.
Yeah.
Retail investors reacting to the headlines rushed into gold expecting it to protect them immediately.
And they got crushed.
Because the Fed was hiking rates at the fastest pace in modern history to fight that 9.1% print, gold dropped roughly 19% from its peak. The financial media was filled with think pieces declaring that gold was permanently dead as an inflation hedge.
I remember those articles.
But if you apply the broker's DD 35-month lag model, 35 months after the mid-2022 inflation peak puts us exactly in mid-2025. Whereas gold in early to mid-2025, it is sitting at staggering all-time highs, well above $2,700 an ounce.
It's incredible.
The mathematical model worked flawlessly. It just operated on a timescale that the average reactionary retail trader simply didn't have the patience to endure.
The actionable takeaway here is profound. If you see inflation hitting the headlines, never buy gold on CPI day. It is mathematically the wrong move in the cycle. The optimal entry point is 2 to 3 years after a massive inflation shock, precisely when the bitter medicine the Fed used to cure the inflation starts making the broader economy sick.
That is exactly how to trade the cycle.
But as clean as that cycle sounds, there is a major wrinkle in the study's data for that exact time period, isn't there? The study highlighted that the 2022 to 2024 period actually broke a long-standing historical rule regarding real interest rates.
Yes, and this is where we have to look at structural regime change.
Yeah.
Normally, the relationship is very straightforward. Gold struggles immensely when real interest rates are high.
Right, because real rates are simply nominal interest rates minus inflation expectations. If you can get a guaranteed 3% return above inflation just by holding a government bond, gold is highly unattractive.
Precisely. But the broker's DB data shows an anomaly. It notes that gold actually performed best, averaging a highly positive 1.931% monthly return during extreme high real rate environments of over 2%. However, the researchers are careful to note that this statistic is massively skewed by the specific data from 2022 to 2024.
Let me challenge that. Real rates were incredibly high during that window because the Fed had hiked aggressively, but inflation expectations were coming down. The traditional model says gold should have been absolutely crushed. Why did it rocket to all-time highs anyway, completely defying the gravity of high real yields?
Because of an unprecedented structural shift in global physical demand. This was primarily driven by the People's Bank of China, the Reserve Bank of India, and other emerging market central banks.
The Eastern Central Bank stepped in.
Yes. Following the geopolitical events of 2022, specifically the weaponization of the U.S. dollar system via sanctions, sovereign de-dollarization initiatives rapidly accelerated. These central banks realized they had too much exposure to Western fiat currencies.
They needed to diversify away from the dollar.
The physical demand from these non-Western state actors was so intense and so utterly price-insensitive that it simply overpowered traditional Western macroeconomic gravity. They stepped into the market and broke the historical correlation with real yields.
That is a fascinating realization. You have Eastern central banks basically looking at the highest real yields in decades and saying, we don't care what the paper yield on a U.S. Treasury bond is. We need to secure the physical metal outside the Western banking system.
They were playing a completely different game.
Which actually provides a perfect thematic bridge into our next major topic, asymmetry and the U.S. dollar. We established in Section 1 that the dollar is the undisputed heavyweight champion of moving gold. When the dollar goes up, gold goes down. But the broker ZB researchers looked deeper into that dynamic, and they found that the relationship isn't just a simple mirror, is it?
Far from it. The researchers uncovered a massive mathematical asymmetry that is crucial for portfolio construction. They didn't just look at daily ticks. They analyzed sustained year-over-year dollar regimes. And they found that when the US dollar index enters a confirmed strong bear market, meaning the dollar is losing more than 5% of its value year over year against foreign currencies, gold absolutely explodes.
How much of an explosion?
During those weak dollar regimes, gold generates an annualized return of 28.33%.
Okay, so a dollar drop of 5% triggers a massive 28% upward leap in gold. If we follow basic linear logic, the inverse should be equally punishing. If the dollar enters a strong bull market and goes UP by 5% year over year, gold should crash symmetrically by 28%, correct?
You would logically assume that, but the data says no. In a strong US dollar bull market, a highly restrictive macro environment, gold doesn't crash symmetrically. It doesn't even post negative returns.
Wait, really?
It actually still generates a positive 7.80% annualized return.
I need to make sure I understand the mechanics of this. The dollar, which is gold's primary nemesis, is having a historically strong year, and gold still manages to grind out almost an 8% positive return. How can it have an inverse correlation but still go up when the dollar goes up?
Because the inverse correlation exists heavily in the day-to-day and month-to-month volatility. But the long-term structural tailwinds we discussed earlier, the M2 money supply expansion and geopolitical physical demand, provide a rising floor. In quantitative terms, this is called convexity.
The convex hedge.
Exactly. Gold acts as a convex hedge. It captures a wildly disproportionate share of the upside when the macroeconomic environment favors it, when the dollar weakens, but it strongly limits your losses, or even manages to grind slightly higher when the environment is historically hostile. This asymmetric return profile is exactly why institutional investors use gold as a primary portfolio anchor. It is effectively an asymmetric anti-asset.
If you are constructing a defensive portfolio, that completely changes the math of your allocations. You are getting aggressive, leveraged style upside capture during a dollar bear market, but you aren't paying the typical catastrophic penalty during a dollar bull market. That is an incredibly rare characteristic in financial markets.
It's the holy grail of risk management.
And if a portfolio manager wants to know exactly when to maximize their exposure to capture that 28% upside, the study identifies what they explicitly call the ultimate forward predictor.
Yes. The researchers isolated the yield curve crystal ball. Specifically, they analyzed the 10-year minus 2-year Treasury yield spread.
Let's briefly explain that for anyone who isn't a bond trader. Under normal conditions, a 10-year bond pays a higher interest rate than a 2-year bond because you are locking your money up for longer. You take on more time risk, you get more yield.
Right. When the yield on the short-term 2-year Treasury rises higher than the yield on the long-term 10-year Treasury, the curve is inverted. According to the entire 22-year data set, buying gold during a period when the yield curve is actively inverted yields a staggering positive 46.91% return over the following 24 months.
46%.
Over 2 years. For comparison, if you just buy gold randomly during a normal upward-sloping yield curve, your return over a 24-month period averages only 19.77%.
That is massive alpha. You are effectively more than doubling your expected return over a 2-year horizon simply by checking a free public chart to see if the yield curve is inverted before you allocate capital.
It's that simple.
But let's dig into the why. The bond market isn't magical. Why does the yield curve have such a seemingly psychic predictive power over physical gold prices?
It is not magic. It is a highly predictable 6-step mechanistic sequence that plays out in the macroeconomy. The yield curve inversion itself doesn't directly cause gold to rise. Rather, the inversion is the earliest leading indicator of a deeply entrenched chain reaction. Let's walk through exactly how a macro portfolio manager views this sequence.
Okay, take us through the 6 steps. Step 1.
Step 1. The curve inverts. This happens because the bond market collectively realizes the Federal Reserve has over-tightened short-term rates. The smart money starts buying long-term bonds, driving the 10-year yield down, signaling a deep belief that a severe economic slowdown is inevitable.
They see the recession coming before anyone else. Step 2.
Step 2. We wait. Usually 6 to 18 months after the initial inversion, the hard economic data actually begins to weaken. Unemployment ticks up, manufacturing contracts. The recession the bond market predicted finally arrives.
Okay, step 3.
Step 3. Reacting to the economic pain, the Fed is forced to capitulate and aggressively cut short-term interest rates to stimulate the economy.
Which brings us to step 4.
As nominal rates plummet, real yields drop into negative territory, completely eliminating the opportunity cost of holding zero-yield gold. At the same time, rate cuts are almost always paired with massive fiscal stimulus packages from the government. directly fueling the M2 money supply debasement thesis we discussed in Section 2.
Printing more money to save the economy. Step 5.
As the recession deepens, corporate credit stress rises. Remember the high yield spreads crossing 6% from earlier. This brings massive safe haven capital flows into liquid assets.
The panic buying. And finally, step 6.
Step 6, the most important step for the massive alpha. Sophisticated macro funds, sovereign wealth managers, and central banks understand this entire sequence perfectly. They know steps 2 through 5 are mathematically inevitable once step 1 occurs.
So they don't wait.
They do not wait for the Fed to actually cut rates. They front-run the entire sequence. They start accumulating massive physical and paper gold positions while the curve is still inverted, driving the price up explosively well before the broader retail market even realizes a pivot is happening.
I love how clear that sequence is. The yield curve inversion is essentially the bond market ringing a giant systemic warning bell. Gold, or rather the smart money trading gold, hears the bell and starts splinting the race before the rest of the market has even laced up its shoes. It's front-running the inevitability of central bank panic.
That's exactly what it is doing.
But all of this macro sequence analysis operates on timelines of years and decades. Let's zoom in significantly. What if you are an active trader? Section 6 of the Broker's DB study focuses entirely on temporal mechanics, analyzing gold down to the month, the week, and even the hour. And there are some incredibly specific statistical rules here, starting with how to handle the NFP jobs report.
Non-farm payrolls, the monthly U.S. jobs report released on the first Friday of the month, is notorious for causing wild, unpredictable volatility across all asset classes. A very common piece of advice peddled to retail day traders is to fade the news.
Right. The logic is that the initial market reaction is usually an algorithm-driven overreaction. So if gold spikes violently upward in the first minute after the NFP release, you should immediately short it, betting that it will reverse back to its mean.
The broker's DB data proves definitively that this common retail strategy is a recipe for disaster.
So the data says you should absolutely not fade the NFP news. Why?
The researchers examined 260 individual NFP events utilizing granular 6-hour bar data. They discovered a highly consistent pattern. The directional movement established in the first 1 to 6 hours immediately following the NFP release acts as a perfect predictor for the asset's direction over the subsequent 72 hours.
Wow.
If gold establishes a strong, definitive directional candle in those first few hours, that momentum persists and typically amplifies over the next 3 continuous trading days.
Think about the psychology behind that. If institutional capital sees a jobs report that fundamentally alters their view on impending Fed rate cuts, they don't just buy for 5 minutes and stop. It takes days for massive funds to reposition billions of dollars of capital. So if you see gold shoot up like a rocket on Friday morning after a jobs report, do not step in front of that institutional freight train thinking it's going to quickly bounce back on Monday. The momentum is real and it is sustained.
Exactly. You do not step in front of the train.
What about the broader calendar? Are there certain months where institutional flows make gold a statistically better or worse bet?
There is massive verifiable seasonality in the gold market. January is the undisputed king of gold trading. Over the 22-year data set, January averages a positive 2.99% return with a highly reliable 63.6% win rate.
That is a huge edge for a single month.
Right.
Why January?
This is not arbitrary. It is entirely driven by institutional rebalancing mandates. Large asset managers, pension funds, and sovereign wealth funds operate on annual cycles. They receive their fresh capital allocations and updated risk parity models on January 1st, and they immediately deploy that capital into strategic defensive hedges like gold to set their baseline risk for the year. That wall of mandated buying pressure overwhelms the market.
It's just mechanical buying.
Purely mechanical. On the exact opposite end of the spectrum, June is historically the worst performing month, averaging a negative 0.53% return. This is heavily correlated with mid-year institutional profit-taking and a general summer lull in trading volumes.
And the study notes that even the days of the week have a distinct mathematical edge. Friday is statistically the best day to hold gold. And if you think about portfolio mechanics, that makes total sense.
It really does.
Nobody managing serious wealth wants to go into a 2-day weekend holding maximum risk in equities, knowing that a geopolitical crisis, a bank failure, or a global event could break on Saturday when the markets are closed. So they park their transient capital in gold on Friday afternoon to hedge weekend tail risk.
It's defensive parking.
But the absolute wildest finding in this entire temporal section, the stat that fundamentally changes how you view the entire global architecture of the gold trade, is what the study calls the session wars.
This specific data point completely reframes the narrative of who is actually driving the price of gold.
Yeah.
The researchers didn't just look at the daily closing price. They broke the continuous 24-hour trading day into three major geographical liquidity sessions: the Asia-Pacific session, the London session, and the New York session.
Okay.
They then tracked the cumulative returns for each of those sessions completely independently over the entire 22-year span.
Break down the numbers for us because they are jarring.
The Asia-Pacific session, which runs from midnight to 8 a.m. UTC, has generated a staggering positive 121.8% in cumulative returns. In stark contrast, both the London and New York sessions are historically negative.
Negative.
Yes. Over a 22-year period, the London session is down 38.8% cumulatively, and the New York session is down 54.3% cumulatively.
I really want the listener to grasp the magnitude of what that means. If you were a trader who only bought gold when Wall Street opened at 9:30 a.m. Eastern and sold it when Wall Street closed, you would have steadily lost money over the last 2 decades. Every single ounce of long-term profit generated by the gold market since 2003 happened while North America and Europe were sound asleep. Why is the geographical divide so intensely dramatic?
It reveals the deep underlying structural divide between paper markets and physical markets. The Asian session is overwhelmingly dominated by physical demand. We are talking about massive accumulations by Asian central banks, the physical delivery mechanisms of the Shanghai Gold Exchange, immense jewelry market flows in India and China, and Eastern sovereign wealth funds hoarding actual tangible metal.
Real physical bars.
Yes. This relentless physical buying creates a slow, steady, persistent upward pressure on the baseline price. In sharp contrast, the London and New York sessions, centered around the LBMA and the COMEX, are completely dominated by paper trading.
Futures contracts.
Exactly. Futures contracts, massive derivatives, and high-frequency speculative flows. Western financial institutions largely view gold as a mathematical macro proxy to be traded around, shorted against the dollar, or used as collateral. That hyper-financialized speculative paper trading nets out to zero or slightly negative over the span of 2 decades due to the sheer volume of short selling and derivative suppression during Western hours.
So what does this all mean? We have established that the West is essentially playing a giant, highly leveraged casino game with paper derivative contracts, while the East is quietly and relentlessly accumulating the underlying physical metal. That casino mentality actually brings up a terrifying point about how Western traders are measuring their risk in these markets, which leads us directly into Section 7, risk management, fat tails, and intermarket dashboards.
We need to talk about the math of crashes.
Let's talk about those casino games and how standard mathematical risk models are catastrophically failing traders.
To understand the risk, the study first utilizes a complex metric called the Hurst exponent. For anyone who hasn't taken advanced statistics, the Hurst exponent is a way to measure the momentum structure of a time series. It tells us whether an asset has a strong tendency to trend in one direction or if it has a tendency to mean revert.
Meaning it snaps back like a rubber band to its historical average.
Exactly. In this metric, a score of exactly 0.5 represents a pure random walk, essentially coin flip. Gold's Hurst exponent sits at 0.4795.
So it is sitting slightly below the 0.5 random walk threshold. What does that practically tell a trader about gold's personality?
It indicates a weak but persistent mean reversion tendency. Gold likes to snap back. It heavily punishes overextension. To prove this practically, the researchers applied Markov chain analysis. A Markov chain basically looks at the probability of the next event in a sequence based only on the current state. They looked at winning and losing streaks. The question they asked was, if gold has 4 consecutive positive months of returns, what is the statistical probability that the 5th month will also be positive?
Now, in a strong, momentum-driven asset like tech stocks or crypto, you would assume that a 4-month melt-up implies massive underlying strength and the momentum would likely carry it forward into month 5, right?
That is exactly how most traders think, and it is why they lose money. The Markov chain data shows that after 4 consecutive positive months, the probability of a 5th positive month occurring is just 8.3%.
8.3%. That is an incredibly low probability.
Yes. It means an extended winning streak of 4 months has an over 90% chance of violently reversing in month 5. The data proves that gold strongly, mathematically punishes greed during extended rallies. If you are looking at a chart and you see gold has gone up 4 months in a row, the historical data is screaming at you that you should expect a reversal, and adjust your leverage accordingly. That is highly actionable intelligence for anyone managing an allocation.
Right.
Do not blindly buy the top of a 4-month melt-up out of FOMO. Fear of missing out will destroy your portfolio. But what happens when gold does reverse? How bad can the downside actually get? Because the Brokers DB study uses a statistical phrase here that sounds deeply ominous: excess kurtosis. Excess kurtosis is a statistical term used to measure the fatness of the tails in a probability distribution curve. To break that down, standard financial risk models, things like the value-at-risk models used by major banks or the Black-Scholes model used for options pricing, assume that asset prices follow a normal Gaussian bell curve distribution.
The standard bell curve.
Right. Under a perfect normal bell curve, most price action happens near the middle, and extreme events taper off predictably to zero. In a normal distribution, the excess kurtosis is defined as exactly zero. Gold's calculated excess kurtosis in this study is an astonishing 9.11.
9.1. The number itself sounds massive, but we need to translate that into what it means for the money in a listener's brokerage account. How does a kurtosis of 9.11 alter reality?
It means that extreme tail events, massive, sudden, violent price crashes, happen far, far more frequently than standard mathematical models predict. To put concrete numbers to it, the researchers looked at a 5 sigma event. For gold, a 5 sigma event is a single-day price drop of roughly 4.9%. According to the standard normal distribution math that underpins most risk management software, a 5 sigma event should theoretically only occur once every 13,000 years.
Wait, once every 13,000 years. So according to the math being used by Wall Street risk managers, a 5% daily drop in gold shouldn't have happened since the dawn of human agricultural civilization.
Precisely. That's what the models say. But what does the actual empirical reality show? In the 22-year data set analyzed by Brokers DB, a 5 sigma event happened 19 times.
19 times in 22 years. The mathematical model says it is essentially impossible since the Ice Age, and the reality is that it's happening almost once a year.
Yes. And the disparity gets even worse as you move further out the tail. A 6 sigma event, which is a drop of nearly 6% in a single day, should be mathematically so rare it is virtually impossible to comprehend. Yet in this 22-year window, it happened 9 times. A 7 sigma event happened 6 times. This extreme fat tail behavior is exactly why standard risk models fail catastrophically when applied to gold trading.
We've seen this historically with the collapse of highly leveraged funds like long-term capital management.
Exactly. If a portfolio manager's risk model tells them a 5% crash is statistically impossible, they won't use a hard stop loss or hedge that risk. But if that impossible crash actually materializes every 14 months, it will completely wipe out a leveraged account. The study's ultimate conclusion here is that because of these extreme fat tails, using hard, non-negotiable stop losses when trading leveraged gold is mathematically mandatory. It is not a stylistic trading choice. It is an absolute necessity for long-term survival.
That is a phenomenal, sobering warning. You are not safe just because the software model says you are safe. The foundational assumptions of the model itself are flawed when applied to this specific asset. Now, moving away from analyzing crashes in a vacuum, the study concludes its deep data analysis with 2 fascinating intermarket ratios. They look at gold not as an isolated asset, but dynamically compared to other vital commodities. Let's start with the macro implications of gold versus oil.
The gold-to-oil ratio is a classic macroeconomic indicator that simply measures how many barrels of crude oil you can purchase with exactly 1 ounce of gold. Under normal, healthy economic conditions, this ratio remains relatively stable within a specific band. But the researchers found that when the ratio spikes aggressively above 25, meaning 1 single ounce of gold suddenly buys more than 25 barrels of oil, it acts as a severe, highly accurate global recession warning.
Why specifically oil? What is the transmission mechanism connecting a precious metal to crude oil?
Oil is the ultimate, undeniable proxy for industrial demand, manufacturing output, and global economic growth. If the global economy is humming, factories are running, and planes are flying, oil demand is high. Gold, conversely, is the ultimate proxy for safe haven wealth preservation and systemic fear. When the ratio violently spikes above 25, it tells you that safe haven demand is radically overpowering industrial demand.
It's a divergence of realities.
Over the 22-year sample, every single time this ratio spiked above 25, it perfectly coincided with or immediately preceded a significant, tangible economic downturn. It flashed right before the 2008 financial crisis, during the 2016 global industrial growth scare, and right at the onset of the 2020 COVID crash. It is a brilliant, noise-free macro dashboard indicator.
So, if you are managing your own retirement account and you notice on your dashboard that gold is becoming incredibly expensive relative to a barrel of crude oil, that is the market's underlying mechanics telling you it is time to batten down the hatches on your broader risk-on equity portfolio. The gears of the global industrial economy are grinding to a halt while institutional capital rushes for the life rafts. What about the other major ratio they analyzed, gold versus silver?
The gold to silver ratio is one of the oldest and most actively watched trading signals in existence. While gold is viewed as stable money, silver is highly volatile because it has massive industrial applications alongside its monetary history. It often acts like a high beta leveraged play on economic cycles. The researchers calculated the historical percentiles for this ratio over the dataset. They found that when the ratio hits the 95th percentile, which mathematically equates to a point where 1 ounce of gold buys 88.41 ounces of silver, silver is historically and extremely undervalued relative to gold.
I have always liked looking at this dynamic as the rubber band trade. Silver is like gold's hyperactive little sibling. Gold goes out for a steady walk, and silver runs way out ahead during a boom, then gets distracted and falls way behind during a bust. When the ratio stretches past 88, that implies the rubber band connecting the two has been pulled as tight as it can possibly go without snapping.
The data fully supports the rubber band analogy, and more importantly, it proves that the rubber band snaps back violently, creating massive alpha. If an investor were to just buy silver completely randomly on any given day, their average one-year forward return is about 9.8%, with a 54.9% win rate. A slight edge, but nothing spectacular. However, if you exercise extreme patience and only allocate capital to silver when the gold-to-silver ratio exceeds that extreme 88.41 threshold,
Right.
your average one-year forward return explodes to 36.4%, and your win rate jumps to 79.1%.
Let me repeat that for the listener. By waiting for one specific verifiable data point, you achieve an almost 80% win rate and a 36% annualized return. That is incredibly consistent edge. It is an extreme high probability buy signal for silver. You just have to possess the discipline to wait for the ratio to stretch to that absolute extreme.
And if there is one overarching thematic conclusion to draw from this entire Broker's DB study, it is exactly that: patience. Whether you are waiting the full 35 months for the delayed inflation lag to finally price in, or waiting up to 24 months for the yield curve inversion sequence to play out across the macroeconomy, or waiting for the gold to silver ratio to finally cross 88. The data unequivocally proves that gold rewards deep structural patience and severely punishes short-term reactionary trading based on the daily news cycle.
Okay, we have covered an immense amount of ground today. We started at the 30,000-foot view with 67 macroeconomic indicators and drilled all the way down to hourly Asian session flows and 5 sigma risk models. We promised at the beginning of this deep dive that we would provide a shortcut to being well-informed. So let's bring all these disparate pieces, the macro, the time frames, the risk, the ratios, into a unified final framework based purely on 22 years of hard empirical data.
Synthesizing this massive amount of data into a unified framework requires us to categorize the drivers by their specific timeframes. If we look at the day-to-day time frame, gold's price action is driven heavily by geographical session flows. Specifically, the relentless physical accumulation happening during the Asian trading session, while the Western paper markets merely create volatility.
Month to month.
Moving on to the month-to-month time frame, the primary drivers are entirely dominated by the US dollar index and real-time treasury yields. Zooming out further to the year-to-year horizon, the most powerful predictive signals are the 10-year to 2-year yield curve inversion, which front-runs central bank policy, and the 35-month delayed reaction to major consumer inflation shocks.
And then the longest time frame.
Finally, when we look at the decade-to-decade structural time frame, gold is fundamentally driven by the expansion of the M2 money supply and the long-term debasement of fiat currency.
When you lay it out like that, it is incredibly logical. The problem isn't that gold is erratic or unpredictable. The problem is that investors are constantly looking at the wrong indicators on the wrong time horizons. They watch today's CPI print hoping for a quick day trade, completely oblivious to the fact that it's a 3-year lag indicator. They watch the VIX spike during a stock market sell-off and wonder why gold isn't saving them, when they should be monitoring high-yield corporate bond spreads to detect actual systemic credit stress. Once you properly align the correct macroeconomic indicator with its mathematically proven time frame, gold stops looking like a mystical, frustrating mystery and starts functioning like a highly predictable machine.
All of this empirical mapping is incredibly powerful, But it raises an important question, a forward-looking question that we have to consider based on the glaring anomalies we discussed earlier in the data.
You're referring to the 2022 to 2024 anomaly, where the traditional real rate rules seemingly broke down.
Exactly. We noted that from 2022 to 2024, gold broke its historically ironclad inverse relationship with real interest rates. It rallied to staggering all-time highs despite high yields, entirely because of massive, unprecedented sovereign de-dollarization and physical hoarding by Eastern central banks. The question we must ask is this. If this geopolitical trend of accumulating physical metal outside the Western banking system continues, are we entering a totally new structural regime?
A completely new paradigm.
Yes. If traditional Western macroeconomic indicators like the Fed funds rate, the daily CPI prints, and Treasury yields begin to matter less and less, and Eastern physical demand begins to dictate the baseline price absolutely, will the next 22 years of data look anything like the last 22 years?
That is a brilliant, provocative thought for you, the listener, to chew on as we wrap up. Are we currently witnessing a tectonic, once-in-a-century shift where the old statistical correlations we just spent an hour breaking down are actually dying? If the very structure of global finance is actively shifting from the west to the east and that physical demand floor becomes permanent, the fundamental rules of gold might be undergoing a permanent rewrite right in front of our eyes. It is absolutely something for you to keep a very close eye on as the global financial order shifts.
It absolutely is. The rigorous quantitative data from Brokers DB provides an impeccable map of exactly where we have been and how the machine has operated for 2 decades. But as a smart investor, acknowledging the potential for structural regime change is vital for anticipating where we are actually going next.
Wonderfully said. You are now armed with the mathematical truth behind 22 years of institutional gold data. The next time you see a financial pundit on TV confidently screaming that gold is crashing because of today's inflation print, or telling you to blindly buy gold because the stock market fear index just ticked up, you have a new superpower. You are utterly immune to bad financial media narratives. You know to look at the dollar, you know to watch the yield curve, you understand the necessity of stop losses against fat tails, and you know to respect the quiet power of the Asian session. Thank you for joining us on this incredibly deep exploration of the macro correlation Bible. Until next time, keep questioning the narratives, stay curious, and always trust the data.